What is a margin call? I'm Clay, let me explain. First off, a margin call is not good. I'm racking my brain right now and I can't think of one situation where a margin call would be a positive thing. I suppose that might not be right, but I'm about 95% sure that a margin call is not anything that could be good, but perhaps I'm missing out on something. But what exactly is a margin call? Well, first off, understand that margin is another word for a loan. I'll put a link to a video below where I talk more about a margin account, but that's where this is all coming from. So you can't have a margin call unless you have a margin account. Again, I'll put the link down below and you can watch that video on what is a margin account. But from a top kind of big perspective, just when you see margin, actually I'll do that right now. Just picture margin as a loan, because that's what it is. So a margin call is a situation where basically the loan has spun out of control and that your broker, the person who has made the loan to you is saying, no, hey, things are out of control. We're in the business of making money. We want to make money. In order to make money, we need to protect ourselves and protect themselves by not allowing risk to get too far out of control, which is what I want to show here. So what do I mean by out of control and all that sort of stuff? Well, let's just look at this right here, and we'll just call this a trade. And we have the start, and then we have, we'll just call it, well, technically not the end, but it's just someplace in the future. So just, this is just time, and time is going like this. Now the big pitfall with this, it can happen in either situation, but usually when people go short, meaning people think that a stock is going to go down and you can make money when prices go down. Again, I'll put a link down to a video below where I talk about what is shorting. But again, from a top down, just kind of general perspective, shorting means going short means that you make money from prices going down in value. If this is the first time you've heard it, you're like, wait, you can make money when prices go down? Yeah, it's bizarre, but it's totally possible. So that's what shorting is. So this is where a lot of people are going to get margin calls. And this is the most typical area where you would see it. So in other words, at the start, and just to make these numbers up, let's say that somebody goes short, meaning they think the price is going to go down, and they go short when the price is at $75. Meaning they want to see the price go to 70, 65, 60. That's how they're going to make money. But at this point, and this is all different, all brokers have different kind of margin requirements as it's called. But the point being, a broker needs to protect themselves because they are giving a loan to do all this the way it works. And if you stop and think about it, how high can a price go? Well, theoretically, it can go in infinity, right? Something can keep going up and up and up and up and up and up forever. And when you go short, you actually lose money when prices go up, right? Because if you make money when prices go down, then the opposite would be true. You lose money when prices go up. So when you stop and know that the fact that, prices can go up forever, then that means theoretically losses can be infinite. And that is exactly why a broker really needs to protect themselves, because they understand that theoretically speaking, they could lose like everything and then everything again, because if a price just goes up and up and up. So it's a risky situation, but it's not risky because that is why, again, a broker has margin requirements and margin controls, and they have all these parameters set up before you go in. And when I say go in, before you establish a trade. So again, hopping back into this, as soon as you get short, then like I said, based on all these other variables I'm not going to get into, the point is that their broker is going to have some sort of, and yellow being used for caution, but some sort of, we'll call it caution point out there. Where let's just say that the price continues to move and move. So in other words, the price is going up. It's doing the exact opposite of what this person thought it was going to do. And now all of a sudden, and I'm just making this up, let's say that based on all these other variables that I'm not going to get into, at $90, they're going to reach out and say, hey, you're at risk of a margin call. You need to either put more money in or you need to get out, but you need to start to take action because your risk is getting high. And they care about your risk because, it could potentially be where your risk bleeds into them starting to lose money. And remember, brokers are a for-profit business, so they don't want that. So they're going to give you a heads up and say, hey, things are getting out of control, you need to put in more money. You need to put more money in your account. Sometimes they'll give you a couple other choices, but pretty much they're trying to give you a heads up. They are cautioning you, this loan is starting to get out of control. You need to do something. So you have a choice there. But I mean, you don't necessarily have to do anything. But there is an area where they're going to give themselves the green light. And they're going to go. They're going to go with what? Well, they're going to go with the margin call. And this is where, so let's just say, and they know this amount based on all the computers and algorithms and all that sort of stuff. They know that if the price goes up to 105, they are going to go with the margin call. So what does go with the margin call means? They sell your position. They force you to take the loss. And wait, that's my money. That's my trade. That's my position. No, it's not. No, it's not. Don't forget about that word. They have given you a loan. So they have every right to be like, fine, if you're not going to be disciplined, if you're not going to do what we cautioned you to do, then we will take matters into our own hand and we are going to sell the position. We are going to end the trade for you. So this right here, also why I didn't want to quite say this is the end of the trade, because at this point is actually where the trade ends. The difference being you as a trader did not end the position. Your broker did, because they issued that margin call against you. So that is what a margin call is. A margin call happens when things spin out of control and you allow them to spin out of control. And that's why I say I can't think of an instance where this would be a good thing. I've never had a margin call. I don't say that. I don't think most people will never experience this, but I've talked to people on my podcast that I offer that have had margin calls where the positions liquidate and it's not a good situation. So that is how it works. At the core, you are taking a loan in a margin account, especially when you go short. If your loan starts to get a little on thin ice, you're going to get warned. But if things continue to spin out of control in regards to that loan, because your broker is in the business to make money and they are threatening, or they're threatened to actually lose money on the loan, well, that's where they're just going to margin call it and end the position to protect themselves. And it doesn't really protect you, because by the time the margin call happens, your account is essentially blown up anyways. I suppose you could come out with a little bit of money left over. Sometimes you might actually owe a little bit of money to your broker. But yeah, a margin call is designed to flat out protect your broker, not really designed to protect you, because by the time it reaches the broker, like at this stage, that could be to protect you, although it's probably already pretty painful at that point anyways. But if it were to ever get to a margin call, your account would probably be pretty destroyed. But it all circles back to, this is why in trading, you have to have rules. You have to have discipline. You have to have a true life system in place in order to protect from these sorts of things happening. But as far as if you've heard anybody saying, oh yeah, and I got a margin call, or oh, I was almost going to get a margin call, these are the things, and this is what they're referring to. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up, as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.